build events. Those in this mission have an equal amount of audaciousness. They have the power to do it time and time again. Until we're honored to be part of some of the world's great stories. Stories that give wishes and understanding. For 2713.
Hello. Welcome. How's everybody doing this afternoon? That's good. Welcome to the Dallas Entrepreneur Center, or the DEC as we call it. My name is Trey Bowles. I am co-founder and CEO. We are super excited you guys are here this afternoon. Obviously, we've got some really exceptional programming tonight, and we're excited for this wonderful partnership we have with the Capital Factory. Can you guys help us welcome the Capital Factory to Dallas? I'm sure Josh will talk more about this, but this move to a Texas-wide initiative to really leverage all the great things that are going on in different cities is really exciting, and I think a huge smart move for us. Great leadership by Josh in helping move this forward, but we're excited to do this and really leverage the value of all these different major cities across the state. How many of you have never been to the DEC before? Wonderful, welcome. Glad you're here. Let me tell you briefly about what we do. We are a 501c3 nonprofit organization that helps entrepreneurs in 3 different ways: through education, mentorship, and community. Education is teaching aspiring entrepreneurs how to actually be entrepreneurs. Things like how do I develop a business plan, and what's a balance sheet? Why does it matter to me? Or how do I hire and fire people? All those things that is the practical application piece of building a business. Second, and we think exceptionally important, is mentorship or coaching. So often the one thing an entrepreneur needs more than anything else is the one thing that he or she doesn't have, and that's experience. And you can gain experience in one of 2 ways. You can either earn it, which takes time, money, and a bunch of mistakes. Most of us don't have enough money to make all the mistakes we're going to make and still launch our business. Or 2, you can learn it. And so we've developed a network of mentors that can help entrepreneurs remove obstacles that stand in their way of helping them get their business to the next level. And third is community, and that's why we do things like this. Partnerships with Capital Factory bring in all different kinds of events. We have a co-working space in all of our different locations that you can look at. We have co-working, we have dedicated space, we have offices. Our goal is to take entrepreneurs and help connect you to customers, partners, capital, promotional opportunities. What we really want to do is help see you succeed and recognize that as we look at this ecosystem, which is North Texas and now other parts of Texas, we can really help an entrepreneur take things from an idea to actually successful, sustainable business. So if you've never been here before, or any of the DEC staff standing around back here, oh, there they are. Here's the DEC staff. Meet with one of them, and they will be able to tell you more about what we do and how you can get involved. The one thing that we ask when people cross our threshold over there is that when you come into the DEC, your goal is to find someone you can help, and really creating that give first mentality of how we can help support an entire ecosystem. So thank you guys for being here. We're excited about getting a chance to talk to you and excited about tonight. We do have one rule at the DEC before I hand things over to Josh. Oftentimes, it's very nerve-wracking to get in front of a group of people, and it's kind of scary to get up here and have to talk. So what we want to do is we want to make everybody that comes on the stage feel welcome. So every time somebody comes up on the stage tonight, we want you guys to stand up and giving them a rousing round of applause. So can we practice this first with Josh, who's from Austin coming to Dallas? Can we give him a nice Dallas welcome? To the Dallas Entrepreneur Center, Josh Baer.
Awesome. Well, thank you so much for that great intro. And thank you, Trey. I'm Josh Baer, and this is our Intro to Fundraising in Texas. This is the first real Texas edition. We've been doing this for a long time as the Intro to Fundraising in Austin, and now we're really excited to be able to expand it and to share it here with you today. I really want to at first just give a big shout out and thank you to Trey and to everybody at the DEC. We couldn't be here today if Trey didn't really have a big vision for how we could all work together and seeing the possibilities of the synergies that happen when we collaborate. And that started actually with a guy named Ben Lamb. Ben is an entrepreneur who's in both Austin and Dallas, so not surprisingly was one of the first people to kind of see some of those connections and really actually physically push Trey and I together and say, you guys need to talk more and figure this out. So thank you to both of them for really helping to make this happen, and like I said, to everybody at the DEC staff. So we're going to talk about the Intro to Fundraising today. And first, I'll tell you what's going to happen. I'm going to talk for a little bit about the beginning, and then we've got some great guests to come up to bring up after, and then lots of time after that for all of us just to hang out and talk, and for you to get to talk to anybody that you want to. But first, I'd like to just get a little bit to know of who's here in the audience today. So we've already asked this like 5 times, so I won't ask you again if it's your first time at the DEC, but really glad to see so many people here at the DEC. That's part of, I think, one of the great things about doing these kinds of events is we want to make sure that we're not just promoting all the great stuff happening across Texas, but really helping to lift up all the places where we're at, and places like here at the DEC. Who here, any UT alums? UT Austin? Got a bunch, UT Dallas? Bunch more? Awesome. I teach entrepreneurship at the University of Texas at Austin. What about, who's recently moved to Texas? Texas is one of the fastest growing states. How recent? Yeah. 1 year. Who's moved here in the past year? Not that many, actually. Wow, that's really different from Austin. I mean, in Austin, if you ask who just moved here, like everybody raises their hand. That's different. All right, who was born in Texas? About half of you. We got some real Texans. All right, who's the founder of the startup? Awesome. A lot of you. You're in the right place. All right, who's looking for investors? All right, no brainer. You're also in the right place. Good. All right, B2B or B2C. You're working on consumer stuff. Not nearly as many. Yeah, that's a little harder in Texas. We'll talk about that too. And then what about B2B? Of course. All right, we like you guys too. We love you all. All right, awesome. That's really helpful. Here's what we're going to talk about today. I'm going to talk a little bit about why Texas. What's this whole Texas story? And for us, that goes into what we call the Texas Startup Manifesto, which is just really big fancy words for we think Texas is awesome, and we're going to tie it all together and see what synergies we can make out of that. I'm going to talk a little bit about what I think it takes to raise $500,000 in Texas, and why that number. It's not exactly that number, but that's kind of the number that most tech startups and other kinds of startups, when they're just getting started, that's usually around the amount of money they're trying to go raise, and it's kind of a milestone. So it's an interesting number to talk about. Then we'll list out all the different accelerators in Texas, all the different angel networks, all the different VCs or venture capitalists, and then we're going to bring 3 venture capitalists up here on stage, and we'll be able to talk to them and ask them questions. You'll be able to ask them questions too. So I'm going to go through all of this. I'm going to try to go through fairly quickly, partly because it's all online, so you don't have to take notes. This deck that I'm using right now is bit.ly/Texas fundraising, so you can all access it there. And then all of these events that we do get live streamed and recorded over the internet. So there's a big group of people back in Austin watching all of this from Capital Factory, and other people watching it over the internet. That's that tiny little camera popped up in the middle over there. And those right now all get published at austintechlive.com. We're working on Dallas Tech Live. And then the meetup group for this is dallasstartupscene.com. We're going to be doing more other events like this as well. And the blog post that describes what I'm going to talk about what it takes to raise $500,000 goes into detail of that at bit.ly/500K 2017. So if there's anything you want to write down or remember, that's all the stuff. You don't have to write anything else down the rest of the time. And I'll show this again at the end. Also, some other great online resources. I try to make sure that the things we talk about here aren't things that you could just go watch online or see somewhere else easily, but that's why we have a lot of question and answers and people up here to talk to. But some other great resources that you might want to check out. Paul Graham has this great article just on fundraising in general, paulgraham.com/fr.html. This VC economics post from Wealthfront is a great way to understand how the venture capital's business model works. If you're going and asking them for money, it's really helpful to understand what they're trying to do and how their business works when you go do that. And then the Sam Altman startup class had some great videos that came, and a playbook that came out of that he put together. So those are all some really great resources too. Okay, and then last notes before we jump into it. This is part of a series that we do. In Austin, we do a different talk like this every Tuesday. The first Tuesday of the month is always the intro to fundraising. And so now, instead of just doing that every month in Austin, every month we're doing it in a different city. So this week, this month it's Dallas, and who knows, maybe next month it'll be in Houston. We also do sessions on how to become a mentor or an investor. We do pitch practice sessions to help people practice their pitch if they're going to be up on stage presenting. We do an intro to the Austin startup scene, which is more for people that are new to town, new to startups, want to plug into startups and things like that. And there's a happy hour for those people. And then we do an event called Epic Office Hours, which is, and these are all of our events that are open to the public. The Epic Office Hours is like a massive speed dating event to help entrepreneurs plug into the scene and meet potential mentors and other people that can help them and get a lot of feedback really quickly. And the first one of those we're doing in Dallas is actually tomorrow. It's not too late to sign up for it or just to come if you want to be part of it. It'll be here at the DEC from 1 to 4 p.m. And we've got a bus full, besides there's a whole ton of Capital Factory people up here from Austin today, but there's a bunch more people coming up tomorrow just for this event. And they're coming up, they're some of our best mentors and most active and engaged people at Capital Factory, and they're coming up to go meet Dallas entrepreneurs and see if they can help. So we'd love to have you all participate in that if you can as well. The link for that is dallasepicofficehours.eventbrite.com. All right, so let's talk about Texas. Texas is totally kicking ass. And I think you're all here, so you all know that, but it really is. Texas has been doing really well for quite a while, and it looks like it's well positioned to keep doing that. It seems like everywhere you look, Texas is just at the top of all the lists. Here's the Kauffman Foundation's survey of startup activity, pointing out that in this particular case for 2017, Texas was the #2 startup state, coming off of #1 in 2016. Obviously, none of this is an exact science. You can measure it lots of different ways, but the big takeaway for me for this is obviously Texas is doing really well and has a really lot going on and compares really favorably to most of the other states out there. And when you look inside of it, it turns out that the cities inside of Texas are all the top startup cities. In fact, we've got 4 of the 11 largest cities in the country. We also have 4 of the 11 largest startup hubs or startup metros where the most is going on. And it's all the cities you'd expect: Austin, Dallas, Houston, and San Antonio. So Texas overall is just doing really, really well. And my impression, I don't know what you think, but I think things are only getting better. We certainly have some challenges, like every place that grows fast has to deal with housing affordability, with transportation. We want to get more funding into Texas. There are things that we need to work on, but overall, Texas is doing really, really well, and I certainly feel pretty good that the next 10 years to me look just as good as the past 10 years. I don't think it's slowing down. So that leads us to the Texas Startup Manifesto. And really, it starts by this triangle that connects together the 4 different cities. And really, in many ways, I feel like this is one of the biggest opportunities that's missed out there, that they don't see the power of connecting these places together. Because each of these cities by itself, may not be the best startup city in the world, and I think they're all great, and I think they're only getting better. But by itself, I don't know that any of them is going to take on Silicon Valley. But when you put all these cities together, when you create Texas, Texas could take on any city, any state, any country in the world. And that's I think the opportunity that we have here. We have when you bring all this together, it's really interesting. And the other part of it is the geography, that they're all so close together. There's almost nowhere else in the world where you have these 4 cities this large, this close, where it's this easy to travel. And I was in Austin this morning, and I could be home tonight. I happen to be staying overnight tonight because we have that event tomorrow. But I've done lots of day trips up here to Dallas, and lots of people on my team have. And so what that means is that if you're in Dallas and you want to tap into some of the stuff going on in Austin, you don't have to move to Austin. You can just go there for the day. Last week, 2 weeks ago, we had Tim Cook, the CEO of Apple, down in Austin because he was doing a big announcement in Austin, and he was at Capital Factory, and he got to do a tour, and 6 startups got to go and demo their apps to Tim Cook, which is pretty freaking awesome, life-changing kind of thing for your startup, right? that there should have been a Dallas startup down there, and there could have been, and there's no reason why if you had the chance to pitch to Tim Cook, you wouldn't have driven down there for it. And the same thing goes for investors or mentors or customers or other people that you might want to tap into, and that's what we're hoping we can bring together. And I think it flows both ways, because you know what? There's a lot of reasons why people would want to come from Austin up to Dallas. In addition to the obvious things like investors, there's so many big companies based up here. And then also private equity. There's a lot of family offices and other wealth up here and other things to tap into as well, besides mentors and startups and other people that could help them. So for us, it is like Trey said when he came up here, it really is about the mentoring. You can find all kinds of great stuff on the internet, but the really impactful things happen one-on-one and in person. And for us, part of this manifesto is really about connecting people together across the state. And so it won't just be us traveling back and forth, but like we're hoping to show today, where we brought 2 venture capitalists up from Austin to be here tonight, and tomorrow we've got a whole bunch of mentors coming up, and then we've had startups coming from here going down to Austin, and we want people flowing back and forth both ways and see lots of that happening. So, and while the biggest complaint, I'd say, certainly in Austin, and I think around Texas in general from startups, is that we would like to see more funding, we wish there was more funding, we want more options for funding, not because we've got a lot of great investors, but obviously it's always great to have more, and they want more funding coming in. I think one option is, what most people think of normally is, well, we need to get more Silicon Valley money here, we need to get more of the funds investing here instead of in Silicon Valley, and we can do that. But there's another option, which is how do we get more of the money that's already in Texas investing more into technology and startups as well? And I think that's a big untapped opportunity that we can look to as well. So here are just some quick examples of the kinds of things that I think you'll see happening over the next few months as a result of this partnership of what we're doing here in Dallas, what we're trying to do across the state. But it's entrepreneurs in Dallas connecting with mentors in Austin remotely over Skype, Capital Factory hosting community events in Dallas like we're doing tonight, entrepreneurs from Austin driving up to pitch with maybe some company up here, entrepreneurs in Dallas driving down to Dallas for a day full of office hours or to meet with investors coming in from Silicon Valley, and entrepreneurs all over the state really connecting to each other virtually. And that happens through this platform, this online platform we use called Union, which is not something we developed, it's actually a global platform that connects startups and mentors and investors all over the world. We're using it to connect together Texas, but the side bonus of that is as soon as you get on a system, you're part of this global network and you can tap into investors all over the world. And something that was actually very unexpected to us, we really were focused on the Texas aspect of this to start, was that one of our entrepreneurs in Austin, who just recently joined the program, he happened to be an international entrepreneur, which probably made that person a little more open-minded to thinking about it this way, went online, found somebody in the system who was a really good fit for them, for their industry and what they were working on, who happened to be in Dubai. He reached out to that person, scheduled an office hours over Skype, met with a person who ended up investing in their company, and then introducing them to a bunch of other investors in Silicon Valley that invested more. And that's pretty awesome. And that was happening from here to Dubai. Imagine what'll happen if we just get Texas better connected together. So, couple things now about fundraising. First of all, when you talk about fundraising, one of the first questions to ask is, should you fundraise at all? Why, are you appropriate for venture capital? Should you raise investor money? And here's a useful tool that I found for how to think about this. The first thing to ask yourself first is, how big can this business be? How scalable is it? And how capital intensive is it? How much money does it take? And that'll kind of drive you towards what the obvious things are to go do. In the case of, hey, this is a very scalable business, it can be really big, and it's also really capital intensive, it requires a lot of money. Example of that would be something like Uber, which if you understand the business, you start to look into it, you see it's actually very expensive for them to open new markets and grow. Well, that's a good fit for venture capital, because you probably aren't going to be able to do it any other way. It takes so much money, you have to go to venture capital. And because it can be a really big business, it's worth it. It's worth it for them to invest. The other side of that is something that's not very scalable and not very capital intensive. That's the bottom left-hand corner. Well, if it can't be that big of a business, then no VC is going to invest in it, because they only invest in things that can become really, really big businesses. But also, if it's not that capital intensive, maybe you don't need any investors, right? You can start it without much money. So that's a good business to bootstrap, to start without investors and to grow on your own. And maybe, doesn't mean you never ever take investors, but that's kind of how to think about it when you get started, is it doesn't take much money, it's not going to be that big of a business, this is a good business for me to bootstrap. The not very interesting spot is if it's not very scalable and it's very capital intensive. that's usually just a bad business. You probably don't want to do that, right? It takes a lot of money and it can't make much money. So you probably don't want to do that. You probably don't want to fund that. And then the interesting part gets in the top left-hand corner, and that is it's very scalable and not very capital intensive. And there's only more and more businesses like this, right? Because it's only costs less and less to start a company now than it ever did. And so in that situation, you get to ask yourself a third question. And the third question is, what are the barriers to entry? How hard is it for someone else to compete with me? If it's very hard for someone else to compete with me, if being a first mover is a really big advantage, or if I have some kind of technology that protects me, or if it's a niche that I don't think anyone else is going to go after, then it still might be a good fit for bootstrapping, because I can take my time, I can move at my own pace, and I don't have to worry as much about competitive pressures. But if there are weak barriers to entry, if it's easy for someone else to compete with me, and I think it's going to be really competitive, then that's another reason to lean towards raising venture capital, because that's going to allow you to move faster, to be more competitive, to gain more market share, and to try to be more competitive in that environment. So this is just, I think, it's simple. This doesn't answer all your questions, but a helpful way to think about where do I fit into this matrix, and is my business an appropriate one for raising venture capital? A key part of that in here is how scalable is the business? How big can it be? And I think most people just try to lump every business into thinking like, well, this can be a huge business, and they don't really have a way of putting a bounds on it, of understanding their market size. And that is really important when you think about going and raising money, is making sure that this is a business that can be big enough to support raising venture capital. Okay, so how do you raise $500,000? Again, why $500,000? I talked to 1,000 entrepreneurs a year. This is what everybody starts with, about $500,000. Maybe they're raising $1 million, maybe they're raising $400,000. It's usually somewhere about in that range when they're starting to get serious. Before this, you might raise $25,000 or $50,000, a little bit from friends and family or other things like that. A lot of times you don't need much proof or to accomplish much to raise that first money. But these days, if you want to go raise $500,000 or $1 million, there's a pretty high bar, because there's a lot of people trying to do that, and investors have a lot of different things to go look at. So here's what I think it takes, and these 5 things. They are a little bit subjective. It's not black and white, but at least it gives you a starting point and a way that you can go evaluate yourself and figure out where do you fit into this puzzle, and how easy is it going to be for you to raise money. The first thing and the most important is the team. In the early stages of a company, when you're investing in startups and tech, it's all about the team. That's one of the most important parts. If you have a great team, if you have a really experienced team of people that have done it before, that investors are dying to work with, then nothing else matters. Actually, that's all you need. If you have, if you're a serial entrepreneur and you've done this a whole bunch of times before, then you probably have other investor contacts, and people are dying to go invest in you. And just when you have an idea, people will go throw money at you. But chances are, if that was you, you wouldn't actually be here right now, because you would need to come to the intro to fundraising. And most people I talk to, that's not the spot they're in. They don't have a million people throwing money at them, and they're trying to figure out what to go do next. And so your team still really matters a lot, but you still need to have a team that people believe in. But really what that comes down to is why you? Why are you the right people to go do this? And that's both passion and expertise. So part of it is why you, because why do you care about this more than everybody else? Why is this such a fit for you, and why are you going to be the one that's going to be successful at it? And another part is, why is it a fit for you because of things you've done or your experience or other things like that? Sometimes it might be your pedigree. For a lot of tech investors, having worked at Google or Amazon is a really strong thing for the team. That they'll see that as a really positive benefit. Having had a medium success before, even if you didn't create a company that went public and sold for $1 billion, if you created a company that was successful in any way, that's a good mark in your favor. But the team is going to be one of the most important factors and the first thing you're going to look at. Now, interestingly enough, of all these things, the team is actually the easiest one to fix, and the thing that can make the biggest impact on your business. And I think it's so often overlooked. And people are sitting there banging their heads against the other 4 things, going like, well, how do I get more traction? How do I do this? How do I do this other thing to go make myself more investable? And actually, the best thing they could go do is add someone to the team. Because adding someone to the team changes everything about your company if it's the right person, and can completely, immediately make you more fundable. So something to really think about. And also, as a startup, often you can get great people to join your team, and oftentimes you don't think you can. You think, like, why would they join some startup? But actually, it's easier than you think. So that's the first thing I would take away from that. The next thing is the market. We talked about this a little bit on the previous slide, but investors that are investing venture capital dollars, they need to invest in businesses that can become really big businesses. The kind of catch-all for that is usually a billion-dollar business, that it can become, a billion-dollar market. And the general rule of thumb there is if it's a billion-dollar market and you get a big chunk of it, say you have 10% of the market, which for most markets is a good market penetration, then you have a $100 million business, right? And so and that starts to become the kind of business that could go public, produce the kind of returns that investors want. Obviously, bigger is better, right? They'd love it to become a 20, 30, $100 million business. And it's possible for investors to make money on businesses that don't become billion-dollar businesses. But usually they have to believe that it has the potential to become a billion-dollar business. It has to be in the realm of possibilities, or it's going to be hard for you to raise money. You need to have meaningful traction with customers. And that's what most people need to raise money. Not everybody does it. Some people raise money without any traction on just an idea, but it's fewer and fewer people because it's getting easier and easier to get started. It's cheaper and cheaper to start a business. There's more and more tools and more help to get you going. And because of all those things, more is expected of you. You're expected to get more done. Because when investors are looking at your deal versus somebody else's, it's going to be, here's this thing, I've got an idea, here's what I'm going to go do. And someone else is going to be like, well, here's my thing, I already built it. I got 5 people using it. It's real. And that's going to usually look more attractive. That's going to look better. And so you're going to be expected to get something up and running. To get customers on board. I'm mixing two of these things together. To get customers on board, have customers you're talking to that are really interested in it, that people know really want it. Very often I have people come pitch me ideas for businesses where they're doing something that no one's ever done before, and they look at me like it's totally obvious that people are going to use it and pay for it. And it's just not. It's really hard to get people to do things they've never done before. So if that's what you're doing, if you're doing something that's making somebody do something they've never done before, you're probably going to have to show proof that you can actually get people to go do it. And getting customers to sign up in advance or to take some other action is a good way to go do that. Social proof from a key investor. So there's a little bit of a catch-22, but in order to get investors, one thing you usually need to do is convince that first person, right? And that first person, often being an influential person or a leader that other people look up to, can make a big difference. Because a lot of investors are followers, and there's a whole bunch of people I could tell you that I trust where if they invest in a company, I'm not going to ask a whole bunch more questions. That's like almost good enough for me. I'm probably really interested in investing too. And so a lot of, especially angel investors, will work that way. And when you're raising a $500,000 round, it's probably coming primarily from angel investors. And then finally, a minimum viable product. I actually put this last. I do think you usually need it, but I don't think you always need it because it's possible to get customer traction without building a product. And it's possible to get social proof and all these other things without building a product. But usually you're going to have to build a product, like I was saying before. Usually you're going to have something working and somebody using it, some proof that you can execute, that you can get stuff done, and that if you build it, people will use it. Like, that the dogs eat the dog food. And so you usually have to build something. So these are the 5 key things. I think all investors look at things different ways. Different investors you talk to might give you a different list. But if I had to break it down, I find most of the companies I'm talking to fall into those 5 buckets. And when I meet with them, I can usually pick 1 or 2. And I'm like, that's where you're missing. You're missing this part. You either need to focus on that or change something else about the business. Okay, I am a little bit behind on time, so I'm going to go quickly through these lists. Again, all of these lists are posted online at bit.ly/Texas fundraising. So again, you can reference them as well. But these are the lists of all the different investors. Now, there are different blog posts maintained in different places that try to list out all the investors in Texas. It's actually kind of hard to do. The list is changing all the time, which is a good thing. There's new investors and situations changing. People's definition of what an investor is different, and who counts or what doesn't, and do they actually have funds they're investing or things like that. But this is my list of who I see in market that's active doing things. And I break down a couple different ways. The first one's accelerators. An accelerator is a program. We run one at Capital Factory. I know there's a bunch of other ones here in the room tonight that particularly focus. Of course, then saying that, then I immediately realize one that's not on the list that's here tonight. So I'll point that one out. But they generally have some kind of a program. They often will focus on a particular vertical, and they work to help you get ready for investors and get ready for funding. And that's going to be a bunch of different things. It usually involves mentorship and advice. It usually involves some amount of funding that they're giving you themselves, and then usually some kind of event or thing to help get you in front of investors. And so you can see a bunch of different focuses here. Athena Health focused on health tech, and Health Wildcatters I know is here in the room. also focused on health here in Dallas. Manifest does cybersecurity. The one I'm so embarrassed to miss is RevTech, which is on the wall here and was here at the DEC, and David's here from RevTech, and they focus on retail technology here in Dallas. SKU does consumer packaged goods, so think things where distribution on store shelves is a really key part of their success. And then there's a little bit more general tech accelerators like Techstars for Capital Factory that work with all kinds of tech companies out there as well. And this list, like I said, this list is always changing. There's new options and things coming to Texas. But these are all resources that can help you to get ready to meet investors, and that's usually why people go to them for all kinds of different reasons. But the big reason why people usually go to an accelerator is they're ready to go raise funding and they want help meeting investors and preparing themselves for raising funding. Here are the angel groups in Texas. There are quite a few of them. The Central Texas Angel Network, which is the Austin Angel Network, is really the most active. They've got hundreds of members, and they're one of the most active angel groups in the country. But there are also active angel groups in Houston and around the state, and many of them collaborate. One group will do a deal, and they'll syndicate it across the other groups too. The angel groups tend to be more conservative than a typical angel investor, partly because they're all working together to evaluate and screen deals. So usually you're going to need to get some angel investors in first before you're going to get the angel networks on board. Like I said, they tend to be a little bit more conservative. And they all have different application processes where you can apply online and submit real pitch to them. Okay, now, the big list of seed investors and venture capitalists. There's different ways you can break this down. I broke it down into seed and Series A. It's a little messy because lots of the Series A investors will also do seed deals, and some of the seed investors will still participate in Series A deals. But this is where I think they tend to focus, where they tend to be really focused on investing. And you can see there are a lot of seed investors in Texas, and some of these are fairly new. Active Capital down in San Antonio recently announced that their first closing on their fund. And they're typically doing B2B companies, but all over Texas. Align Capital focuses on IoT. Chris Schonk at ATX Seed Ventures particularly does a lot. We'll do consumer deals, which is a little bit harder to find investors that'll do consumer stuff. Blossom Street here in Dallas, which came out of the Dallas Angel Network Fund. Capital Factory has a fund. We do not have the most money, but we are one of the most active investors in startups across Texas. Stephen Hayes is here tonight from Deep Space. He does all kinds of deals, but in particular really likes esports and gaming. And then Interlock is a fairly new firm. I don't know if Jason's here, but Jason Story and his partner have a new firm here that's also based in Dallas. And then there's a whole bunch more. Obviously, Mark Cuban's here in Dallas and invests all around the world, but is very active. Moonshots Capital with Craig Cummings in Austin focuses on military vets in particular. Notley Ventures does a lot of things, but also does quite a few social good ventures. That's one thing that's interesting about them. And then True Wealth Ventures, Carrie Rupp and Sarah Brand, they're particularly focused on investing in female entrepreneurs and businesses that sell into the home. And another fairly new fund is WPP Ventures, Kenny Tomlin, and that's a corporate arm of WPP, which is a big agency, or has lots of agencies all over the world, and they are typically doing ad tech and media type things that plug into those. So seed rounds, this is again typically your kind of $500,000 to $1.5 million, but you're often rounding up from a bunch of different people. Sometimes you'll get a VC to participate. They might put in $250 or $500 of that, you're hoping that they're going to then do a bigger investment in their next round. And then here are the Series A investors. So ADX is what's kind of and I believe they might be in the process of rebranding now as well, but that's kind of what has come out of what was Austin Ventures and Chris Faciti, who's still doing that. Fathom is a fairly new fund. He's based in Silicon Valley and in Austin, and they particularly really kind of like data center infrastructure type businesses. We have Krishna from Live Oak here with us tonight, and his partner Venu. They do all kinds of technology businesses, and also both of them were previously at Austin Ventures. Blair Guru at Mercury, based out of Houston. They're very active all across the state and around the Southwest, primarily in tech deals. Tom Ball was previously at Austin Ventures. He's got a new fund called Next Coast. And then S3 is a very active investor in Austin, also in tech. And then we have Mike Dodd here with Silverton Partners. They're, I think, sort of the firm that we've invested with the most in Austin, where they're very active doing lots of tech deals there. So those are just a list of some of them. You can find other lists online, and again, this deck is all available if you want to go through it and see all of them. But those are really the active investors here in Texas. And then here's an interesting list, because these are all VCs who aren't in Texas, but they come here on planes because they have other investments here. And so they're regularly coming here. And that's a really good place to start when you think about trying to talk to investors outside of Austin or outside of Texas, is talk to people who, for them, it's not going to be an extra trip. They're already coming here for some other investment, so it wouldn't be a big deal for them to come to meet with you as well when they come. And so Chicago Ventures has been really active here. First Round Capital just made their first investment in Austin in a while. Mike Maples at Floodgate, very active in Texas. Shasta's recently been doing some new deals here. Upfront Ventures just did Waldo Photos last year. And Brian Stoley at Wildcat too. So I'm sure there are more than just those ones, but those are the ones that I'm seeing around most recently. And then most of that was all tech. Actually, one of the questions I should have asked at the beginning was who here is in tech and who wasn't. Our folk, and you'll see a lot of my comments tend to be really slanted towards technology businesses, and that's where most of the investment dollars in Texas tend to be. But these are some of the other investors in other areas like consumer packaged goods, more straight consumer businesses, and biotech as well. All right, so like I said, you can find all of this online. The one URL at the top, bit.ly/Texas fundraising, and this whole deck, and so it has all the links and all the lists and everything that you just saw there. The recording of the event as well will be up there. And while the recording, the slides don't change a lot from month to month, although they do change a little bit. What happens next is we're going to bring up 3 venture capitalists up here on stage, and we'll talk with them. And every time we do this every month, there's different venture capitalists up on stage. And so one reason you might go look at the old videos is not to watch the presentation over and over again, but to watch the Q&A with different VCs and to see how they think and what they talk about. A couple other quick announcements. If you're looking for more detailed instructional type content, there's a great series put on by one of my co-founders at Capital Factory, Gordon Doherty, called the Founders Academy. He does it every quarter. You can participate in person, where he's done it in Austin, he's done it in Houston. I'm sure he'll come and do it up here in Dallas. And then he also streams all of these over the internet as well, so you can participate remotely. And in addition to that, he's been developing a content library of videos over the past probably 5 or 6 years. And so when you take this course, you get access to the whole content library, which has videos on a whole bunch of specific topics about things that can help you with your business. And then here's another just general reading list. I find for most of the people that are interested in this types of topics, these 3 books are 3 that are places I would start that I find really helpful. The first one, Running Lean, is about the lean startup methodology, and that's a really helpful tool for a lot of businesses. It's not necessarily for every single business, but if you're just getting started and you're trying to validate your idea and figure out who your customer is and what the right thing is to go sell, Lean Startup can be very, very helpful. And I think this is one of the most practical, most helpful books by a guy named Ash Myra, who's also here in Texas. Also from some Texans, this book, Get Backed, is about how to go get funding. And it's really about how to run this process of going after investors, how to create your pitch deck, how to reach out to investors, and how to be successful with it. It was written by 2 really successful entrepreneurs in Austin, Evan Baer and Evan Loomis, no relation to me. And it's a really great book that's done really well too. And then the last thing is Venture Deals. It was written by Brad Feld and Jason Mendelson. Brad Feld is one of the founders of Techstars, really famous venture capitalist, really prolific writer. And this book is kind of like, from most people, it's kind of like the Bible of venture capital. This is like really just all the way to get up to speed on all the different terms and how things work, and how the whole business operates and how to raise money. So some different good, valuable resources for more information. All right, so next up, I'm gonna invite up our 3 guests to come up for the Q&A. So if you don't mind, let's give them another big standing round of applause like you did for me. For Mike Dodd, Stephen Hayes, and Christian Mary Lawson. Come on up. I'm going to introduce each of them briefly myself and give them a minute or 2 to tell you a little bit about just kind of what types of companies they focus on investing in, and when you'd be ready to come talk to them. Every VC says, "Oh, come talk to me anytime. Come to talk to me early. We like to meet people early." So I don't want that answer. But they're really like, when would they be like ready to be invested in? What kind of stage is it interesting for them to talk to you? And so first up, we've got Mike Dodd over at the left. And Mike, I first got to know when he was at Austin Ventures. He was an entrepreneur before that, and so he's been an operator working with successful businesses, but then also was investing at Austin Ventures and worked with him on some companies there. And then most recently, he now joined Silverton Partners, and I've done a lot of deals with Silverton over the years. So Mike, can you tell us just a little bit about what you kind of think of, like, what's Silverton's world and what kind of things you invest in, and what's the sweet spot? When are they really ready for you?
How you doing? Hello? Yeah? Okay, thanks. So again, thanks for having me, Josh, and everybody at DEC. Appreciate being here. It's a pleasure. Congrats on what you guys are building here. Better. Much better. So quick 1-minute commercial on Silverton. So we're headquartered in Austin, Texas. The firm has been around for about 12 years. We're just finishing up raising our 5th fund. We are Series A investors primarily, which means typically that we invest when the company has revenue, typically between $25,000 and $150,000 of monthly recurring revenue. We invest in both enterprise as well as consumer. We probably skew a little more towards enterprise than consumer projects. And most of our businesses are actually quite capital efficient. We didn't do Uber, although we do have Favor, which is not that capital efficient. And we're really kind of entrepreneur first. We're known to back our entrepreneurs and go along with them. So as Josh pointed on his previous couple of slides, the team matters in a big way, and really that entrepreneur is the person we're backing first. And market, obviously a big market, we all look for big markets. Our funds are between $75 and $120 million each. Our average check size is probably $2 million for the first check. On average, our companies have between $3 and $7 million invested from us in them. And we also do seed investing, but we're primarily Series A investors. So in a portfolio, in a fund, we may have 22 investments, kind of 17 to 20 are Series A, and the other 4 or 5 or 6 are seed investments.
Perfect. Thanks.
Hey guys, I'm Stephen Hayes from Deep Space Ventures, and that's really loud. Our fund is located here in Dallas, seed stage fund. Is that better? Oh, way better. So,
Talk close to it.
tastes kind of funny, would So, Deep Space Ventures is located here in Dallas. I raised the fund at the end of 2015, launched it in March of 2016. We're primarily a seed stage investor. We've made 15 investments to date. You can boil all of those down into 2 buckets. B2B enterprise software is one. There's 10 investments in that bucket. Esports or gaming, there's 4 investments in that bucket. And then our one B2C investment is in the fintech space, and we did that with Silverton. So that's what we've done. 7 of those deals have been in Dallas, 3 in Austin, and the rest are scattered mostly up and down the West Coast because of gaming with a little bit of East Coast exposure. So
When's somebody ready for you?
Oh, when's someone ready? Good, thank you for reminding me. We're happy to look at a deal super early. I would say 3 of our investments have been what we would call pre-seed, which is before you're ready to even, maybe not even raise the full $500,000 that Josh was talking about earlier. But the bulk of our portfolio is seed stage. So when you're ready to raise institutional capital, when you're ready to raise between 1 to 3 million, and our average check size, which is just under $500,000, would be either a lead investor or maybe your second largest investor in the total syndicate. That's when you're ready for us. For local entrepreneurs, happy to talk to you super early. I mean, at the idea stage even. So it's always helpful to start building the relationship early, in my opinion.
Great. All right, Krishna?
Should I play this? Can you hear me? My name is Krishna Srinivasan with Live Oak Venture Partners, based in Austin, but I've had a pan-Texas investing strategy for a long time. My partners and I, all of us used to be at Austin Ventures. Began our careers at Austin Ventures beginning of 2000, and then officially raised Live Oak Venture Partners. Spent the last decade there, and then came out, and all three of us collectively together raised Live Oak Venture Partners about 5 years ago. First fund was a $109 million fund, and we are wrapping up our second fund currently. The strategy is we put this in 4 buckets. Bucket number 1 is we're very pan-Texas, as I said earlier. Had some great success investing and backing companies here in Dallas. I think we've had about $1 billion plus of exits in the Dallas market, so always excited to go back here. Notable ones where we incubated spatial wireless here, and then seed invested at Mavenir, which went public, and for a $600 million exit. And Navini Networks, also in Dallas. Those were the 3 notable successes here in Dallas. And then today we have 2 companies here in Dallas, which is Raspberry Technologies and Grandeur. And so strategy 1 is pan-Texas in nature. We have a great company in Houston, so think of all markets. So completely agree with the pan-Texas strategy. So huge supporters of what Josh and the team do in creating the network across all 3 metros. Wholeheartedly support that. Number 2 is we are what we call first institutional money, which is either seed or Series A's. If it's a seed check, it's a $250,000 to $500,000 check. If it's Series A's, it's $2 to $4 million for a first check, and then invest across the full life cycle, typically investing 7 to 10 over the life of a company. The bulk, of course, money goes more into Series A's. I would say today we have 20 companies in the portfolio. Out of that, 7 of them started as seed stage companies, 13 of them started as Series A, so definitely the bulk of them start as Series A's for us. Number 3, we are active investors, typically take board seats in everything we invest in. And number 4, we are, again, as Josh said, very much entrepreneur first in investing, so somewhat segment agnostic. Look to back the best companies that can come out of Texas, companies that can be world leaders coming out of Texas. It's very much entrepreneur first, and segment much later in the list style of investing. So those would be the 4 salient features of what it is, and looking forward to making more investments here in Dallas.
Awesome, great. So glad all 3 of you could join us. All right, so I've got a couple questions that I find are the questions that if we just open it up to the audience, I know you're going to ask anyway. And so I'm going to start the conversation off just with us speaking to a few of those. And then when you signed up for this event, there was an opportunity for you to ask a question, to fill one in. And we do have actually a whole room of people watching from Austin as well. They did the same. So we're going to put that list of questions up, and we'll probably cherry pick a few of those to speak to. And we'll open up to everybody here in the audience as well as time allows. So first question is, what's different about Silicon Valley? And so I'd love to hear, you're all welcome to comment, but don't feel like you have to. But what's your opinion of what's different about doing a startup in Texas versus Silicon Valley, in particular around what's going to be different about fundraising?
All right, I have the mic, so let me go. So, clearly what's different about Silicon Valley is the capital, undoubtedly. Let's call it a spade here. You have, we joke, you throw a rock up into the sky, and if it comes down in Silicon Valley, it's going to hit a bunch of capitalists. So there is definitely, undoubtedly, a lot more capital out there, which means a lot more companies get funded, a lot more, people call them very capital-intensive ideas can get funded. Follow-on capital is easier to come by, and so you just definitely have the volume factor working in an entrepreneur's favor there. But you also have a lot more companies being formed there. So as a result, the way I think of it is, ultimately the companies we back don't often look very different from Silicon Valley companies, but they're on the average. But at the extremities, there's definitely a lot more high capital, big dollar bets that undoubtedly happen there in Silicon Valley.
So some businesses that would be hard to do here because they're bigger bets that require a lot of capital?
first round of investing pre-product might take $20 million, just makes it hard to back one like that. We all have, the biggest early stage funds here are all in the $100 million type fund sizes. So if you're looking to do a Series A much beyond the $10-15 million Series A, it becomes hard for local investors to go do those things. But having said that, one of our recent Series A's raised $29 million in Series A in Austin. We were the seed investors of that company, and those guys ended up having insanely outsized execution, which had 5 term sheets and Valley style, and ended up raising that kind of money as well as Series A. So it's definitely possible and doable in the Texas market. It's just a little rarer compared to what might happen in Silicon Valley context.
So Stephen, you said you've invested up and down the coast and in Texas deals. I find just generally there's just like a valuation cut when you leave the valley. It's not about Texas, it's about the valley. But like, would you just expect, like, if you're doing a deal in California, the valuation's going to be higher?
I do. There's more capital chasing deals, so the price of the capital is just a little bit different. It's also a lot less expensive to start a business in Texas and keep it going. So you need less money, and when you raise less money, you raise it a little bit lower valuation. Most of the time, not all the time. The downside of that for the local ecosystem is there's not as much, and I get yelled at for saying this, there's not as much talent here. It's hard to hire developers here. It's hard to find co-founders here. It's hard to find CTOs here. It's just harder than it is in other ecosystems. I think it's a lot easier in Austin. I think it's a lot easier in the Bay Area, but the cost of doing so in the Bay Area is much higher, so you raise more money, and when you're selling 20% of your company, that means the valuation's higher.
All right. Well, so let's talk about valuations, Mike. So, I'm full disclosure, I'm also an investor in Silverton's fund, and so I've seen them pitch me as an investor on like why I should invest in the fund. And part of the pitch is that, hey, we get better values, right? Like valuations are lower here than in the valley. So you've seen a lot of deals, Mike, and you've been involved in a bunch. Why? Can you help us understand how could your valuation be too high? Why would it ever be bad for an entrepreneur to let their valuation get too high too fast?
Yeah, sure, and it's counterintuitive. But this happens in the valley all the time. An entrepreneur raises money. An entrepreneur raises money at a very high price. They raise $20 million at $100 million valuation. They may be only doing $1 or $2 million in revenue. They're going to burn through that money. And typically, if they raise a lot, they're going to burn money even faster. They're going to buy the fancy chair and the nice office space. As opposed to kind of being lean, they blow the money. So when they've grown for 2 years later, they're out of the money, and they've only are at $4 million in revenue, and they've got to go raise money. They need to raise an up round. That means north of the $100 million valuation that just raised that. And it turns out it gets harder. And so the higher the price, the more you get boxed in. You also get boxed in because it's hard to find buyers in the company. Ultimately, you need to get liquidity for your shareholders, your investors, your employees, and you as a founder. And if the last round you raised is $400 million and you're only doing $20 million in revenue, and that happens a lot in the valley, and you're finally like, I'm tired, we need to go find a buyer for this, it may be really hard to find a price north of $400 million, which was the last price you just raised at. You may only find a buyer at $50 million or $70 million. And that's a big mess for you, particularly if you raised $50 million and there's $50 million in preference sitting on top of you. If you only sell for $75 million and you've raised $50 million, there's very little money left for all the employees and you as a founder. So the great thing about building a company in Texas is it's a lot cheaper, as you would say. And because of that, you don't need to raise as much money. Therefore, you don't pile all this money on top of it. And it's a conundrum that's happening a lot in the valley right now, where these companies are getting stuck and they're getting boxed in. And I think over the next couple of years, it's going to get worse and worse because there, frankly, is not that much liquidity for all these big Silicon Valley companies or startups that have raised $100 million. So it's going to be interesting to watch this unwind because there's been a tremendous amount of capital, particularly in the valley, flooded into these companies, but no liquidity at the other end. And they're all sitting on these huge preference stacks. That's a complicated term without getting into detail. But it's going to be interesting. That's why we prefer to invest in markets like Texas, This is capital efficient. You don't need to raise a lot of money. Therefore, you have a lot more optionality if you've only raised $10 million and you built the business to 30 or 40 million revenue.
You know, it's funny that in the news recently was Juicero, right? This big Silicon Valley juicer machine that raised tons of money, and it was for a smart juicer. And in hindsight, all these people are laughing at it and saying what else. But in the commentary about that I've seen, you know, people talking about it, one of the comments I saw that I certainly agree with is that it's too much money is much more likely to kill a company than not enough money. And it really does happen. Is you get too much money and you actually go do really stupid things because constraints are good for you. So it's not a black and white thing. Obviously, in general, within reasonable bounds, higher is better. You want to get a higher valuation. You want to give up less of the company. There are good things about that. But like many things in life, too much of a good thing can go too far. And the goal is not just to drive your valuation up as high as you can, as fast as you can. All right, let's also, another really common question that we'll always get from the audience, and especially when there's venture capitalists here, because they usually have a fairly common answer, is convertible note versus priced equity round. You could throw a safe note into that if you've heard that term. I would just loosely group that with convertible notes for this case here. But most VCs I know don't want to invest in convertible notes. Most entrepreneurs are raising convertible notes when they get started. Anyone want to talk about just how you think about those things, what they're good for, what they're not, and why you might prefer one or the other?
Yeah, you know, so I think we don't mind doing a convertible note round. We've done a bunch of those. Again, it's a function of how much of a round is it going to be. If the round is somewhere in the max of 1 to 1.5 maximum
Million.
Sorry.
Million.
It's easier to get away with a convertible note because they're just a lot less expensive. Companies haven't made quite as much progress yet. The entrepreneurs are better off not to just go attach a valuation to those kinds of deals. So historically, when rounds have been for $1 million, we have generally gone with convertible note rounds. And as you start to eke up towards the $2 million, certainly and above, you definitely want to get to a price round because at least the proceeds from the round are good enough to pay for the legal expenses, etc. And likely the company has made enough progress for it to even warrant taking on $2 million of capital to go do something with it. And entrepreneurs end up having, you know, perhaps not giving up as much of the company compared to how much they would give up when they would go to $1 million round of financing.
Any other thoughts?
We've invested in convert safes and equity. There's positives and negatives from my perspective to each of them, and also from your perspective as a founder. The smaller rounds are mostly converts, a couple safes. You know, as far as investor protections, which is an issue that Mike alluded to a minute ago, I mean, we can build investor protections into converts or into equity rounds, so it's not really, I don't really have a preference, frankly, but it's a little bit easier to get a deal done super early when you're raising 250, 500, 750 just to do a convert, because I think if you go to Wilson Sonsini and raise an A round, you're gonna spend at least 40 or 50 grand on documentation, and you can go to a local startup lawyer here and spend a fraction of that to get a convert done.
This conversation is not going the way I expected it to. Mike, you got it.
Okay, I'll take the other side. Yes, we don't like notes. No, we rarely invest in convertible notes. Different than you guys. But however, if you're on typically we want to do price rounds, we buy equity, not debt. Even though convertible notes generally are more like equity. But if I was an entrepreneur, I have been before, if you're raising up to $750 or $1 million, see if you can get a convertible note. You know, you put a cap on it, or the investors are going to put a cap on it, or maybe you get lucky and there's not a cap. The trick for when you're in our shoes and there's a big convertible note hanging out there is that converts into the equity round, and all of a sudden you think you're raising, you know, $2 million at a 10 million post, so the investor's buying 20%. But then there's $2 million of convertible note that's got to get rolled into that too. And then all of a sudden the entrepreneur says, no, we're at 8 million pre-money plus the 2 million you're investing plus the 2 million of the note, so it's 12 posts. And we go, no, it's 10 posts. Again, not to get into too much detail. So you just got to watch out that you don't pile too much money as an entrepreneur into the note. And lots of times we will demand that they convert the note first before we put our money in. But in general, convertible notes are friendly for entrepreneurs to a point, and I'm all for it. As an entrepreneur.
Good points. I've certainly seen a lot of entrepreneurs not realize how much they've piled up on the note, or that the note has interest and discounts and other things that make the note balloon and get bigger over time. And it can really be a big weight that you're carrying behind you that builds up over time. And at the same time, it's the obvious place to start. Like, that's what you start with the note. It's simple, it's cheap, it's fast, it's fun. Go do that. I generally would do a priced round with, I'd want to have one of these people up on the with someone that does a lot of deals, and they're gonna actually be able to pick a good, negotiate a good price because they know what they're talking about. Another good reason for the note is just to be when you're dealing with maybe less sophisticated investors as well. Keeps it simpler. Do you different now?
Yeah, I agree with that perspective. I think you can definitely get in a bad spot. People don't think about what the notion of a cap that exists. It just feels like a free debt money, but there's a reason there's a cap there. Do the math in terms of dollars raised at the cap. You're effectively giving up a ton of money if you end up raising, I think, north of $1 million. So it's definitely good to have the discipline and say it's not an infinite source of money to go to a convertible note, and show that there's enough progress to go to a priced round as soon as possible. Is what I would recommend. All
right, I don't want to spend too much time on this, but it is a common question that I get. Anybody want to sign my NDA?
No.
And add any just a little bit of color on that? Is that why you won't sign it?
Well, I mean, it's
Why won't you sign it?
going to create a mess if there's an issue.
It could potentially create a mess for me. I can't remember every deal I've looked at or where I've seen every idea. And the last thing I need is for somebody to come back and say, well, you told someone about my idea, you told this other investor, and then they went and told their company, and then they tried to copy it. Like, that just creates a mess. There's a level of trust between early stage investors and founders. I trade in the business of privacy, secrets, knowledge, information, relationships. And if you don't think you can come tell me about your business, and we can establish a level of trust that I'm not going to go try to recreate it, which, hey, I don't have the time to do, I don't really want to do it, and you don't think I'm going to go take the ideas somewhere else. If you think I'm going to do that, don't come talk
Then
to us.
the NDA probably isn't what's going to protect you.
The NDA is really not going to be that enforceable at the end of the day. If you say that I told somebody that you told me that, you just went out and pitched 100 investors and you can say I did it, come on.
So, very common question we get. You're going to get a very standard answer from most professional investors. They don't sign NDAs. And so lots more stuff to look on. But it's just not practical. If you're talking to 1,000 different people, you can't sign NDAs with all of them.
And they wouldn't, no professional investor would sign one without negotiating it and marking it up and drafting it. And I don't think that most founders have the legal budget to draft 100 NDAs.
Yeah. All right, one or two more things, and we're going to open it up to your questions. So one of my favorite, an investor I follow and I enjoy is Mark Suster out in LA. He's with Upfront Ventures, who we mentioned before. And he wrote this blog post quite a long time ago in 2010. He said, I invest in lines, not dots. And what he meant by that is, when I meet somebody at once, that's a point in time, it's a dot. I know where you are, because I just met you, but I don't really know where you're going. I have to meet you more than once. And once I have multiple dots, now I can draw a line and I can see where you're going. And hopefully that's up and to the right. And I can see the progress you're making and what you're doing. And I think a lot of entrepreneurs get the misconception to start that they're going to meet somebody and they're going to meet them and they're just going to decide to invest right away. And that just really doesn't usually happen, especially not for lots of money. So the question for you guys is, or for any of who wants to speak to it, is just, so on average, when you invest in somebody, how long have you been talking to them? And how long does it take? Because I think a lot of people have really poor expectations about how long it takes.
I think it's stage dependent a little bit. I think these guys can speak to Series A and beyond, but for pre-seed and seed, I mean, let me just give you the two ends of the range for what's in our portfolio. One founder I got an intro on Monday, I met him on a Wednesday, and I funded on Friday. That's an exception. Then another story is our first exit, which is closing in the next month. I met that founder. I wanted to be in his deal. We had 7 meetings over a 9-month period. I passed, and then there wasn't room for me, and then I wanted to be at, and it just went round and round and round. Finally got a deal done early this year. So almost a year of us kind of circling around each other. So I think, and then there's all of the different options in the middle. I think to be very clear about the answer, it's very hard to invest after one meeting, one phone call, one email. It happens probably more in the Bay.
Probably more in early stage seed than with
and it happens.
a couple
with
$1 million
investors.
check.
Angel investors in the Bay are known for just stroking a check at a first meeting. I just haven't seen it happen in our market that much.
What about from you're writing a couple $1 million check? What's your relationship look like, Mike?
Yeah, it does vary. It's not within a week. You know, it can be as short as a couple weeks, 2 or 3 weeks, and it can be as long as a year. I mean, we invested in a great company at a capital factory called Aceable, and we passed when we were doing the seed round, and we kicked ourselves for that, but we got a chance to come back and do the A round, and it's been a great one so far. So it really, it's all over the map. But I mean, generally,
What's the average though? What do you think? Most common. It's not 2 to 3 weeks for you guys. I know
No,
that.
it's probably 6 to 12 weeks. So
A few months.
a few months.
2 months.
Yeah.
3 months.
I'd say probably closer to 2.
Yeah.
Yeah, 8 weeks.
So just as you're thinking about planning this out, and that's by the time they got to meeting them and talking to them. Fundraising takes like 6 months, really. Like that's what you have to be. A lot of people I meet, they show up and they think like, oh, great, I'm about to start raising money. Okay, I want to have it raised a month from now, and it's just like it's not happening. That's not the way this goes down.
That's about right, but these things end up being fairly sort of bimodal in nature. The ones, when you have a great first meeting, it kind of looks like when it's a good first meeting. Things that have real momentum, when you're able to have you can see the excitement, the commonality perspective, those end up emerging fairly fast in the 6 weeks to 12 weeks, or even 6 weeks at the low end of it kind of range. The ones that are more tortured likely is an early indicator that ain't going to converge, right? So look for that's one way to kind of tell yourselves whether it's going to happen or not. The ones that really go fast happen fast, or the ones that don't maybe require some change to the model, or maybe the investor needs to see some more lines before they're convinced of that. The same spot here. We've done one where we took a complete redo of the business model, and 18 months later we invested in the company, and that's now exploded for us. We've got one where we should have done the seed round, or the small round, we kicked ours from not doing it. 18 months later, that business has just exploded, and we did a Series A for the business 2 months ago. So it happens all over the place.
All right, so I sent you all, the three of you, this list ahead of time. You might have to crane your neck to look back and see. But these are some of the questions that that the group submitted as well. And so before we just open it up, I was hoping that each of you might pick one off the list. If you want to look around, see if you're inspired by any of these. Any that you want to grab and answer? You want to start? While they look.
The second to the bottom one, how do I impress an investor at a pitching event? It's really hard, but it's certainly possible. In my opinion, when you go to a pitch event, assuming you're on stage pitching, you want to be really concise and tell your story. You want to, usually there's judges, and you want to be really well rehearsed at answering their questions with concise answers. Nothing's worse than when I go to a pitch event, TechCrunch, or whatever it may be, investors are asking questions, and the founders are acting like these basic questions that every VC would ask, or maybe they're not prepared for them, or they're scratching their head, and that's the worst. So be ready to address those kind of questions. And I think it also goes back to what you guys were talking about in the question before. There's a relationship building component to investing. And if I'm a founder and I'm going to a pitch event, and I know there's going to be certain investors there, I'm going to reach out to those investors 3 or 4 weeks before, tell them, hey, I'm going to run into you at this event. I'd love to do 20 minutes on the phone with you before we get there, and just give you kind of a high level of my background, what I'm doing. Then get on stage and do your thing. Then go find them in the crowd afterwards. That's the right way to do it. It's all about relationship building. When you're in a 12-week diligence cycle, you're not going to get a yes in the first meeting. And I think a lot of a lot of founders think that after your first 30-minute phone call, they think you're going to go ahead and say yes. And even if you love it, you're still not going to say yes that fast. So I just rambled a lot, but those are my thoughts.
Cool.
Let me take question 1, 2, 3, 4, 5 or 6.
I thought you were going to do all of them at once. That was
From the bottom. Maybe just to illustrate, the question is, for the last few investments you've funded, how can you give different dynamics?
Wait, I was going to take that one.
We can do both of that too. So just to, I'll give you 2 examples, and in both of those have an example like Mike did. Both of those, one company is called Opcity, and the other company is called Telestacks. Tell you 2 different dynamics there. Opcity is in the real estate deal referral business, incredible entrepreneur. They came into pitch a seed round to us last year. Had founded Yoda before, very early in the business, and they were trying to build this real estate lead referral business, and very early and not clear evidence they can crack into a crowded market at all. So let me take so in that instance, we had a common understanding with the entrepreneur of what they knew and what they did not know, and in that case, clearly we don't know if they can build a business, etc., etc. But we were willing to underwrite the risk that they can get to build a scalable business and attractive business there, because the entrepreneur was a credible guy who had built a couple $100 million business before. We had known him for a while in the local Austin landscape, and so we ended up underwriting a bet that this team can go figure out how to crack the market. So the key point I want to make is 2 parts. A is build a relationship with an investor as a part of the discussion on what do we know and what do we not know and what is the unknown in the business. See, in that case, what we knew was great guys. What we didn't know is can this not scale? But we, as guys being very entrepreneur focused, we're willing to underwrite the uncertainty that these guys can scale and build it. Our bet was right. That business has insanely exploded, the fastest growing business we've seen. And this is the one I talked about, which had 5 term sheets and did a $30 million round of financing, and we're happy we had a good chunk of the seed and being a player of the day. A different company which we looked at 2 years ago called Telestacks, which is doing open source based, enabling communications within applications, huge open source following for the guys. Guys were lean, hungry, and said, well, we don't know how to monetize this open source stuff. A lot of ideas, right along with us, doing $1 million round of financing, and we'll go figure it out together is what they said. And we were like, whoa, there's so many corpses in this whole open source landscape. Many have monetized, but a faster number have not monetized it. So we agreed as to what we knew and what we did not know about compelling technology, unknown monetization. We were not willing to underwrite the risk at the time that in that segment, there was enough evidence that this team could go figure out how to go monetize and build an interesting business on top of the open source engaged on a global basis. We were wrong, and because the team really has crushed it in the next 18, 24 months, and we paid the price by paying a much bigger price when they came back in for their real Series A financing. And clearly the lines were visible as the quote that Josh had put up. And we were we should have underwritten the risk the last time. So the net of it is help draft, clarify, come to a clarity with a prospective investor as to what is really known about the business today and what is not known about the business. I think having the clarity and parsing of that data will help have the conversation as to whether they will be willing to underwrite the risk with you or not. Is a couple of the 2 contrasting examples there.
Okay, I'll be quick. How to get your foot in the door if you're a first-time entrepreneur. This is actually not easy. You got to be a good networker. It's hard to come right to us and get an audience. The best way to do that is find somebody that we know or that knows us and get the introduction in. That's really important. A credible introduction goes, I can't tell you how far that goes.
And the best person is?
The best person is another entrepreneur.
A CEO you funded.
A CEO, yeah. Another entrepreneur CEO that we funded.
Or Josh.
Or Josh. So go find a first-time CEO that got funded. Figure out a way to get to know them, get them to like you, and then get them to be willing to make an introduction on your behalf to one of us. That is the best way to go. And then I'll get your foot in the door. And you got to be a hustler. gotta hustle.
All right, those were some of your questions. Appreciate everyone's been you've been a great audience through all this, and I'm so excited to see all of you here. We got about 15 more minutes to open it up to questions from the audience, and then after that, we're going to roll into. I'm going to point out just a few people in the room so that when we go into the happy hour, you know all the different people that you can talk to, and then we'll go to happy hour. Hopefully, they'll all be able to stay with us for a little bit and join us, and you get a chance to kind of talk to people one on one. So let's open it up to all of you. The woman in the front, please.
Hello, my name is Victoria Frederick, and I'm calling the I'm asking a question around how do you navigate, you have a consumer-facing business in a world that's very tech focused. How do you focus your business on the right thing?
I'm just going to repeat that for everybody. The question was, she has a food space, a CPG type business, and she's like, hey, how do I navigate and get this funded and get resources when everybody's talking about tech all the time?
Yeah, I'll take that. So they're very specific, and in fact, Josh had a list up that just do CPG investing. It's a smaller community of investors. However, the number of entrepreneurs in your space is also a lot smaller. So I think actually you may have a better opportunity to raise money than a tech entrepreneur. You just got a rifle shot and find those folks who do CPG investing. Look, CPG is on a great upswing right now, particularly in markets like Austin, San Francisco, Boulder, Boston, New York, or Brooklyn. There's a ton of really interesting CPG. That whole category is getting completely recreated. Every shelf in the food aisle or every shelf in the grocery store is literally being recreated. I think that's actually a very interesting market, particularly in the natural health food space.
Yeah, and CPG stands for consumer packaged goods, in case I didn't say that earlier. And yeah, I think I do feel like I'm seeing a ton of energy and activity around it. But the thing that maybe the really important point that you're bringing up is someone who invests in tech startups is just not even going to look at that. Like it's not like an investor is just like looking for good deals and they'll look at any good deal. Investors have things they're interested in and they like and that they're comfortable with. And so you need to find the people that get that and are comfortable with that. One that I mentioned previously was SKU, S-K-U, and that's an accelerator focused on CPG startups. And honestly, I think they've got a great track record. I think almost every company that I've seen go through there has gone on and raised funding and be successful. And then there are certainly investors that focus on that. Two that I'll mention in Austin. One's Chris Schonk with ATXC Ventures. I know he's very open to CPG. And then also Dan Graham at Notley Ventures. Dave.
Yeah, hi, my name is Dave Hendricks. I'm CEO of a Capital Factory accelerator startup called Series X.
Thanks for coming up.
So, in Austin. Question to all the investors on stage. So, you just signed $1 million check for my startup. What's your expectation of me afterwards, and what should my expectation be of you right after that happens?
Great question. So the question was, you're to the investors, you just wrote me $1 million check. What's your expectation of me, and what should my expectation be of you?
All right. Please pass the mic off here. Okay. So let me say the expectation of us. I think I'm sure every company we are probably won a competitive auction to be your partner in building this. And as a part of moving and coding, I think we told you that look, we're going to be in the foxhole with you through the ups and downs and be your partner through all aspects of company building. And so you're looking for a partner who's going to be engaged. And you would, if you did your work right about us, you would have hopefully found that we were engaged partners through others' journeys. And you want somebody who will be that way through the ups and downs of building a company and helping you with whatever it takes to get to promised land. The expectation of you would be that the way, again, we think of when we make investments, I think we have a very clarity internally on what we do, what we know, what we don't know. And we get to a common understanding with the entrepreneur of, by the time this money runs out, we're going to go figure out A, B, and C. And we're going to work on tactics X, Y, and Z to go deal with this uncertainty and unknown factor. And we're going to have an expectation that you're going to be transparent, you will work towards executing on those kind of areas to to get the company to the next point of inflection. And you will be collaborative, you will take feedback, and you will be open with us as we together are this to go build a company.
Yeah, real quick, transparency is 1, 2, and 3 for us. The reality is, not everything is up and straight, up and to the right. You're going to have bumps and bruises, and a lot of shit's going to go wrong. The entrepreneurs I respect the most are the ones that say, hey, Mike, look, here's the deal. We didn't win this deal. We screwed this up. The product release is pushed 2 months. Just be upfront with us, because we've been through this a lot. We can help you through the issues. And so being transparent from day one, that's all we ask.
What's
and then send a $100 million check.
What's the communication look like? How often are you talking to them? What are they sending you?
Sometimes I'll go 2 weeks without talking to. We were on every company we're invested in. We're on the board, and then sometimes it's twice a day, or text message 3 or 4 times a day.
Like 2 weeks is a long time.
2 weeks is probably a long time, but it happens.
And I'm on a bunch of boards with some of you, so I know the rhythm. But for those that don't, so how often are they having like big formal board meetings? Like what's that start with an early stage company?
After Series A, it's typically 5 or 6 times a year.
So every other month.
Yeah, every other month. And then there's a lot of at least once a week or every other week we talk. But again, it could be twice a day. It goes up and down. You never know.
Awesome. Right up front. The question was, do you always ask for a board seat when you have a Series A? I think.
Yes.
Or C.
No, not necessarily.
Yeah. Be less likely with seed, more likely with A.
It's very unlikely, and frankly, like seed investors. I mean, if you look at these guys' portfolio over the long run, a Series A investor is going to have less deals but bigger checks. We're going to have a ton of deals, and some of them are small checks, and it's just not physically possible to manage a bunch of board seats.
But if the VC's investing, you should think like their expectation is they want to be on the board. Maybe they're not on in this round, but like that's the intent is they're going to be on the board.
They invest later stage too.
Yeah, I think it's just very hard to be. Typically, I think the same model for my show. We're typically the largest investor in the company. So we are. If you do a Series A, we're typically investing at least half, or more than half the round. And so, being in the board, not only gives us the extra ability to influence and change and so on. That's the reason.
Awesome. The gentleman right here.
Could you speak about pros and cons of strategic investing, whether or not you guys ever seen it as a strategic investor?
So the question was about strategic corporate investors. What's it mean to get a company to invest in your business?
This might be stage dependent as well, so I'm curious. These guys might have a different answer. I've seen great strategic investors in my deals, and I've seen terrible. Great bring you channels to market, they bring you customers, they bring you eyeballs, they bring you resources, sales teams, marketing, they bring you a lot of stuff that you can't afford to do internally as a startup. So I think for the most part, strategic investment is good. Bad side of strategic investment is strategic investors often overpay, and they often invest in a way that precludes VCs who have particular hang-ups about certain terms or certain types of deals from investing. And I've also been in deals where a strategic investor leads around, they take a board seat, they force the direction of the company, but that wasn't the direction the market demanded the company to go in, and it actually really hurt the company. They should have been going in a different direction, but the strategic, who also had control because they wrote a huge check, they ran the company into the ground. So there's pros and cons. I've seen it both ways. I'm sure these guys have different experiences.
Yeah, I mean, that's a sum of it. We generally ask, we're okay having strategics in, but later in the life cycle of financing. So in Series C or Series D, would they buy 5 or 8%? That's great. But when they start owning 20, 30, 50%, no bueno.
As their decision-making process, if you have a board member from a strategic, that person doesn't make decisions for that gigantic billion-dollar company. They have to go through a bureaucracy. And so getting a incentive alignment correct among your cap table and you, and then that crazy, gigantic organization is really hard to do.
The other reason, of course, is that the earlier you take money from them, there often is a corporate deal that goes with it. which might limit your strategic outcomes. They might ask for a right of first notice upon a sale, a right of first refusal upon a sale, etc., which just might limit your exit options. And the later you take money, you're less likely to have those kinds of strategic levers thrown into the table.
They might limit who you can do business with. I've seen strategic investors put an exhibit or an attachment to a deal that says you can't take these people as customers.
Yeah. I think what it really comes, and I've absolutely seen quite a few of these as well, and what it really comes down to is it is a double-edged sword. There's good things that come with the strategic investors, and there are usually some limitations. That's why they want to get involved as strategic investors, because it's something else besides the money. And so it's like, if you could just have the good stuff, it's great. That would be awesome. Like, that's worth doing. But you have to be really careful that you're not giving them any situation where they can effectively prevent you from doing other things, and that's going to come into play of them stopping you from doing business with somebody, stopping you from selling the company to somebody else, or using effectively competing with you is what often can also happen there too. So that you just have to be really careful. I've seen it work out really well sometimes also when a company actually was in a really tough spot, and it was kind of like the only option they had. And you know what? Like, when you don't have any other options, like, that was a good option too, and it gave them a path to distribution, to eventual, sometimes those end up being the opposite of what I just said, because it's your only chance, and they have an option to buy you, and a bunch of other things that you've really kind of locked your path with them. But it was, if you didn't have any other choice, it might be the thing that saved you. So we've probably time for one or two more questions. Let's go way in the back row. That's you. Yep, you turn around.
Any plans to get on the ICO, blockchain, tsunami wagon?
Great question. He said, any plans to get on the initial coin offering blockchain bandwagon? I think I know the answers for you guys, but I'll let you guys go first.
No, not yet. Probably just no in general. I mean, it's
different world.
My view of it is that it's not really a new structure. It's just a new name. It's a securitized asset. And we saw what that did to the mortgage industry. We saw what that has done to a bunch of different industries in the past. So I'm staying away from it.
Yeah, and we've, same thing. We've done a fair amount of studying on just blockchain in general. We're fascinated by it. We haven't found the right project to do. We probably wouldn't do it around a currency. We'd do it in some other vertical. And there's dozens and dozens and dozens of blockchain companies chasing dozens and dozens of verticals, none of which have a lot of traction. So it's, see, this is the problem. When you take these esoteric kind of projects, you can put $4 million in, and it may be 6 years before they get revenue. And you got to keep feeding it. Therefore, it becomes something that looked capital efficient, all of a sudden becomes capital inefficient and takes a lot of capital. And you just get into these hard decisions. We put another $3 million in and hopefully turn over more cards to see if something happens. And so that's a whole world where you've got to be very, very careful. And I think there are going to be a lot of investors that are going to lose money on it. And I think the folks who didn't wait a little bit longer and then put money in are going to make money. There will people will make a ton of money on blockchain. It's just a question of when's it going to happen. And I think it's probably further out than some people may think.
Yeah, and so this is something I've been looking into a bunch recently as well. I think it's a very interesting space that I'm really excited about, but it also makes me realize that it's not where my expertise is. Investing in those kinds of businesses is very different than what I think I'm an expert at, and investing in tech startups and equity type investments. And so I think what you'll generally see is a very similar reaction from most of those types of investors, because to be honest, not to speak for them, but part of what I heard there was like, I don't really understand that stuff. I'm not going to be comfortable going and investing other people's money and going and do that. And the people that do understand that, that's all they're spending their time doing, is becoming experts at that. And so like for me, actually one of our founders at Capital Factory just started a new fund called Multicoin Capital. And it is effectively a hedge fund or investment fund just to go invest in those things, because most people that are doing other types of investments aren't investing in those types of things. And for me, I had been very lucky. I bought about $10,000 worth of Bitcoin at a good time, and then I forgot about it. I was just lucky. I didn't know plan. I looked a couple months later, and it was worth $30,000. I was like, well, that's cool. So I split it up, and I put $10,000 into Ethereum and $10,000 into Litecoin, and then we look a couple months later, and it was $75,000, and it was like, okay, but I'm basically just like hitting the lottery. Like, there's no brains involved in any of this. I'm just like got lucky with it. So then I took that money, $75,000, and I gave it to them. And I was like, all right, you guys are actually like knowing what you're doing with this. And I think, I think that's what you're going to see a lot of investors doing, is giving it to people who that's what they focus on and specialize in. We'll do one more question, and then we will jump to the happy hour, and I'll be around. Hopefully these guys are around, and we'll all be able to chat one-on-one too.
My name is Tyler. I'm an ag tech startup, actually coming out of UT Arlington.
It's an ag tech.
Yeah, you forgot us. But so I'm going in front of an angel group next month, and kind of I've been directed more or less to like stay away from VCs with their income, right? So where do you see like the positives and negatives when you're going to raise the seed fund, coming directly to VC and trying to get that funded, or going angel in that direction? Like, how do you all see that?
I'll start.
Repeat it.
I mean, the angel groups are fine, and go see them. If they charge you money to pitch, that just makes my skin crawl. So don't do that. If they're trying to, I don't know. Yeah, that's garbage in my opinion. I think some of the angel groups are excellent around the state, around Austin, San Antonio, some in Dallas, one in Fort Worth. So yeah, definitely go talk to them. As far as ag tech, there's a number of investors that are solely focused on ag tech, and there's not that many, and they're very easy to get a hold of. If I were you, I would cold call the whole dozen of them that are super focused on seed stage ag tech. And that might be overstating the number that are focused on seed stage ag tech.
Yeah, so part of what I heard there was obviously talk to the right investors. And so you're going to, kind of like to the CPG question, if you're going barking up the wrong tree, it's going to be a waste of your time. But part of the other question I heard there was, should I go to angel investors first or go to VCs first? And that, it's a really hard thing to evaluate, and it's a little bit of like figuring out like, well, how far am I shooting? How big am I trying to make this? Or how big can this be? Or where am I now? And you have to evaluate that for yourself. It's, in general, like, if you could skip all the angel investors and just go get a $5 million check from Krishna, like, that would be a great thing to do. Like, it saves you a whole bunch of time. If you actually know what you need to go do, you can just go start doing it, and you've got plenty of money in the bank to go run with it. Like, theoretically, that's like the best thing to go do. Most people can't do that.
The comment when an angel fund tells you not to seek VC, that's a red flag comment for me. Because if I'm an angel investor and my friends and I are all writing $50,000 checks, the first thing we want is a VC who can fund the rest of the round or the bulk of the round and the next round, and then bring all their friends to the next round and the next round. So not wanting VCs involved if you're an early angel investor, it just seems counterintuitive to me. But that's just my.
So I'm guessing when you heard that, maybe what they were saying was like, don't go to a VC first, and maybe they were thinking you're going to waste your time doing that, or were they saying like, don't ever go to a VC?
They were afraid that if I bring a VC in later, and that the VC will block and exit if the multiple's not high enough. So the angels can exit, the VC firm will get 3 to 5 and then block.
Yeah. The question you said, would a VC block some kind of other exit? That I wouldn't be as worried about. Generally, you're all really well aligned as far as that goes. Like, everybody wants to make as much money as they can, the VCs and the angels, and within reason. Generally, I haven't found that to be as much of an issue.
It didn't sound right, so I wanted to ask.
Yeah, I mean, I can see situations where it might become an issue, but most of the time, people are pretty well aligned with that, and most of the angel investors I know want you to go try to make it a big thing and make it big. So, great. Well, hey, I want to stop there for a second. And first, before we break, I want to introduce a few other people. First of all, let's give a reminder. Trey asked the DEC staff to raise their hands. Can we get any of the DEC staff around to wave? They might be ducking their head over. So if anybody's interested in becoming a member at the DEC or learning about the DEC, that's a great place to do it. Well, how about DEC members? Are there DEC members here? They can raise their hands. I see one there, a couple in the back. So they're members that work here. They'd also probably be great people to talk to if you wanted to learn about it. In addition to that, we've got quite a few people up here from Austin, from the Capital Factory staff. So if you guys could raise your hands to help me see you. So Kelsey's one of our venture associates. She helps screen companies coming into the accelerator and they get funded. Wendell's on our team. He's been helping support the event here tonight. Way in the back, there's, got the glare, Georgia and Kate and Grace and Chelsea and Zach, and so a bunch of people from our accelerator team that work with a lot of different companies here. So all different people you can talk to about things that go on, and then we'll all be hanging out as well. As I mentioned, tomorrow is Epic Office Hours. We're bringing a whole bunch more mentors up. We'd love to have, it's not too late for you to sign up and be part of that. It's DallasEpicOfficeHours.eventbrite.com. And other than that, really appreciate all of you coming. Thanks for being here, and I'd love to meet any of you, so come up and say hi after. Thanks.
I think that's like literally just a networking happy hour, isn't it? I'm not sure. You can right there after you ask her. Yeah. I'm on brand. I do have like, not sleep, but I'm not sure. Like, parking in Ohio. Where are you going? Yeah. Yeah, I need to pay for parking. Well, I don't know. I sort of want to see what's going on here. Maybe I got the wrong one. Yeah.